You've probably heard this number before, $10 trillion. That's roughly the size of America's corporate bond market, and at first glance, it sounds terrifying. $10 trillion of debt. But here's the problem with that headline. The debt itself isn't the most dangerous part. The real risk is what happens when companies have to refinance that debt at much higher interest rates. Because a company can survive a huge debt load when money is cheap. But when the cost of borrowing suddenly doubles, the math can change very, very quickly. And this is where America's corporate debt story gets interesting. For years, American companies had an incredible deal: borrow money cheaply, lock in low interest rates, and use that money to expand, acquire competitors, build factories, invest in technology, or sometimes buy back their own shares. After the financial crisis, interest rates stayed low for years. Then, the pandemic pushed borrowing costs even lower. Companies rushed to issue debt. And why wouldn't they? If someone offers you $1 billion loan at a very low interest rate for 10 years, you're probably taking it. The problem comes later. Let's say a company borrowed $1 billion at 3%. Its annual interest bill is roughly $30 million. Not great, not terrible. Now imagine that debt matures. The company needs to borrow that $1 billion again, but this time investors demand 6%. Same company, same $1 billion. But now the annual interest bill is around $60 million. The company didn't suddenly become twice as productive. It simply became twice as expensive to finance. And that difference has to come from somewhere. Maybe expansion gets delayed. Maybe hiring slows. Maybe dividends or buybacks are reduced. Maybe the company raises prices. Or, if the business is weak enough, it starts struggling to pay its creditors. And here's the key. America doesn't have just one Acme Corporation. It has thousands of companies carrying debt. According to Federal Reserve data, U.S. non-financial corporations had around $14.5 trillion of debt outstanding in early 2026, depending on the definition used. Corporate bonds make up a huge portion of that total. So when we hear a number like $10 trillion, we're not looking at one giant loan. We're looking at a massive ecosystem of companies, banks, bond investors, pension funds, insurers, and asset managers. And they're all connected. That's the machine. Here's the part most people miss. When interest rates rise, existing corporate debt doesn't instantly become more expensive. If a company locked in a 3% interest rate 5 years ago, it can keep paying 3%. That's actually why the consequences of higher rates can take years to appear. The old debt has to mature first. Then comes the refinancing. Imagine thousands of companies reaching that moment at roughly the same time. They walk into the bond market and say, we need another $500 billion, or $1 trillion, or whatever amount they need to replace their maturing debt and fund new projects. And investors get to decide the price. If investors are comfortable, companies can refinance relatively easily. But if investors become nervous, they demand higher yields. And that creates a feedback loop. Higher yields leads to higher interest costs, leads to weaker corporate cash flow, leads to higher perceived credit risk, leads to investors demand even higher yields. Now, the company has an even bigger problem. And there's another layer. The U.S. government is also borrowing enormous amounts of money. So corporate bonds aren't competing for investor money in isolation. Investors can buy corporate debt or treasury bonds or other assets. If treasury yields become attractive enough, investors may demand a larger premium to hold corporate debt. That premium is called the credit spread. In plain English, it's the extra interest a company has to pay because lending to that company is riskier than lending to the U.S. government. So imagine treasury debt costs 4%. A strong company might borrow at 5%. A riskier company might need to pay 7%. Now imagine the economy weakens. Investors become nervous. That 7% borrower might suddenly need to offer 9%. And that's when refinancing becomes painful. But there's an even more interesting twist. The corporate debt market isn't only being used to refinance old obligations. American companies are also issuing enormous amounts of new debt to finance the next investment boom. And one of the biggest drivers is artificial intelligence. Data centers need buildings. They need chips. They need electricity. They need cooling systems. They need networks. And all of that requires enormous amounts of capital. Some companies can fund it from cash flow. Others go to the bond market. So you can have two things happening at the same time. Old debt is becoming more expensive to refinance, and new debt is being issued to fund massive investment. That's a lot of demand for capital. And when everyone wants money at the same time, the price of money matters. This is why the headline, "America has $10 trillion of corporate debt," is actually the least interesting part of the story. The better question is, how much of that debt has to be refinanced? When does it mature? And what interest rate will companies have to pay when they do? Because the debt mountain isn't necessarily the bomb. The refinancing schedule is the fuse. And if that fuse reaches the wrong part of the corporate sector at the wrong time, the effects don't stop with Wall Street. They can show up in investment, hiring, business expansion, credit markets, and eventually in the economy you live in. That's the hidden risk inside America's corporate debt. Not simply how much America owes, but how expensive it becomes to keep the machine running.